From the financial centers of the world, this is Bloomberg Markets with Alix Steel and Guy Johnson.
It's 30 minutes into the U.S. trading day on Wednesday, February 9th. Here are the top market stories we are following for you at this hour. The calm before the storm. Equities add to gains and the bond market stabilizes ahead of tomorrow's U.S. CPI print. Could the inflation data change everything or nothing at all? Need a lift? Lyft shares drop and analysts cut their price targets after riders come up short due to Omicron. It sets the stage for Uber's results post-market with Disney also on deck. And ships and chips. We're taking a deep dive into supply-side challenges this hour. We'll speak to Gene Soroka, director of the Port of Los Angeles, and have an exclusive conversation with U.S. Commerce Secretary Gina Raimondo. From New York, I'm Kaylee Lyons with Guy Johnson in London. Alix Steel is off today. Welcome to Bloomberg Markets. Guy, I get the sense you like my rhyme.
Yeah, that's very good. Ships and chips. You want to make sure you say that properly, don't you? Yeah, it basically sums the show up, doesn't it? We're doing an awful lot of that. Port of LA, we're focusing there. You've got the AP Muller-Maersk numbers out today, as you say. We're talking to the Commerce Secretary a little bit later on. I think we've got XPO on as well. So we're definitely in the shipping, trucking kind of genre today. But I guess it's front and center as we make our way towards that CPI number tomorrow. These are areas in which the bottlenecks have been really quite significant. Kaylee, we're just getting the wholesale inventory numbers coming through. The headline number is the wholesale inventory month-on-month number. This is the December final number. It's actually a little bit stronger than the preliminary number, so we're in at 2.2. So we're seeing continuing strength, continuing pickups in terms of the inventory that we're seeing in terms of where it's held within the supply chain. Wholesale trade sales month on month coming through a little bit weaker, which is interesting actually. But I think the inventory number is really fascinating because we are well above the historic norms. Companies clearly have decided that supply chains are a major problem, and as a result of which continue to hold significant amounts of inventory. And this kind of leads us on to our question of the day. Would hot or cold CPI brew up a bigger storm in these markets? Again, hat tip to Kaylee Lyons. She came up with the story there. I think I started off with the hot and cold thing, but I think you finessed it as ever.
Team effort.
Let's bring in, team game. Definitely a team game. Let's bring in Mike McKee, talking of the team, Bloomberg's international economics and policy correspondent, and Bloomberg Markets, Kriti Gupta. Mike, let's kind of set it up. What do you think we're looking at here? What is the bigger risk, hot or cold, when it comes to that figure tomorrow?
Well, hot for the figure, but I'm not sure that's going to be the reaction in the markets. We are expecting 7.2% annual rate for the headline CPI, 5.9% for the core. And as I put it to John Farrow, since we always are so U.S.-centric on these programs, I will say that is going to be the hottest inflation since Margaret Thatcher was prime minister in Great Britain. But does the Fed pay attention to the CPI this month? Maybe not, because they've got another CPI reading and a PCE reading coming up before their next meeting. And we are thinking that we might see inflation start to fall before then because of base effects in the next month and because some of the effects will work through. Even with inflated energy prices, those won't be going up forever. And if they start to flatten out, then that brings down the month-over-month number.
All right, so that's the implication for the Fed. Kriti, what about the implication for a market that already has priced a great deal of rate hikes in?
Yeah, well, let me just throw you some numbers here because Mike's absolutely right. We continue to see these beats on when you have the economic figures come out, the CPI. Out of the last 12 data points, only one has actually been a negative surprise. So for the markets, they're kind of fine-tuned to the idea that CPI is going to beat despite how high those kind of estimates are. What's scary for the market here is that they've come to expect it. So now, if to answer your question of the day, essentially, what's going to brew a bigger storm? I think a CPI miss would brew a bigger storm, especially when it comes to simply the fact that that the market is so priced in. They are expecting a hawkish pivot from the Fed and, of course, a very aggressive rate policy when it comes to March. So that would be a bigger kind of driver to the downside. Yeah. Let me also bring up the point, though. It's all about what's actually driving the inflation, because it's not just goods, it's not just services, it's energy inflation. If you actually look at the sensitivity in the stock market to oil in particular, that seems to be the bigger driver. That seems to be what spooks it instead of yields.
Okay, well, let's just come back. You talk about sensitivity in markets to this print. Let's talk about where we could see the biggest sensitivity. As you say, energy sector, one to watch out for, but I'm assuming the banks are front and center, and this whole kind of narrative around the value rotation. So just give us your sense. If you get a cold number tomorrow, if it comes in under, let's say we get a 6 handle tomorrow, Chrissy, where do we get the biggest reaction, not just at a headline level, at an index level, but further down into the sectors and the stocks?
Yeah, well, a miss essentially for the CPI number would probably fold best into the likes of big tech, because at the end of the day, even though you do see yields and tech moving together on an intraday basis, directionally they are diverging. So that was probably the sigh of relief that you would see, especially for those investors who are saying that a more hawkish policy would take to tech, or would impact tech the most. But I think once again we have to talk about energy, because I think when we talk about the value trade potentially making a reemergence in 2022, well, we have to talk about the leader in that value trade, which isn't financials, which it was for just a hot month in the last quarter. It's actually energy, which it seems like is the sole pocket in the stock market that isn't that reactive to CPI anyway. So if you're looking to hedge, for example, instead of diving into the commodity market for that kind of inflation hedge, a safer bet might simply be going into the stock market, because it kind of prevents you from all the volatility of the commodity market.
Mike, let's continue to talk about the implications for the Fed as well. Could tomorrow's print make or break the 25 or 50 basis points in March?
No, for the same reasons that I mentioned about the hot and cold, is the Fed's got more inflation numbers coming out between now and then, and they'll look at the next CPI print, which will come out on March 10th, and their meeting's not till the 16th, so they will have time to digest a whole new set of numbers. This is really kind of a question of not whether it's hot or cold in terms of the reaction, but who's in the bathtub at this point, because some people like it colder, some people like it hotter. It's a question of what you're going to buy, not whether you're going to buy. I brought along a chart. I don't know if they have this one ready to go here, but basically you look at what happened the last time in 2008, and they cut rates and then started raising them again when you got to 2015, and the market just kept going up, and they tapered, and the market just kept going up, and they cut rates again for the pandemic, and the market just kept going up. So I don't think the Fed is going to have as much of an impact. It's just on the overall market. It's just going to be on individual sectors and what you decide to buy.
Mike, can I take you back to your first answer? You talked there about the possibility of maybe inflation tapering off from here. Could tomorrow's number be the peak number of this cycle?
It could. When we get into February and March, February is still a chance for maybe a little bit higher, but it could start to roll over, both because of the energy reasons and because of base effects. And then the question is, are we still seeing companies raising prices in the same way that they have been? Or does that slow down because you looked at that inventory number at the top of the show, because inventories are starting to build and supply chains are starting to ease a little bit?
Okay, so if it's not going to necessarily be the peak, though, in terms of the market reaction, Creedy, it could be peak inflation, but we haven't seen, most strategists think, a peak in terms of the 10-year yield. We're now seeing the likes of Goldman revising up their forecast now to 2.25. How soon could 2% become a reality?
Well, it was supposed to become a reality yesterday, right? That's what the market was expecting. So it's supposed to be in the rearview mirror. But, I mean, it could happen any day. Now, you are seeing a little bit of a retreat, and I think that has also breathed just a little bit of a sigh of relief when it comes to equities, because when you get closer and closer to that 2% level in the 10-year yield, it is going to spark just a little bit of volatility. But I think to Mike's point, the stock market tends to look through these things. Even in 2013, 2017, when it did go through that 2% level on the upswing, you saw the stock market kind of shiver just a little bit and then continue climbing higher. So it's going to be a similar story when it comes to that finally hitting that 2% yield. It's going to be a little bit of a convexity hedging story. That gets real nerdy real quick. But essentially, at the end of the day, it is going to just be higher yields, probably higher stock market, simply because of the messaging that we have received. A lot of the pricing for the bond market, and arguably for the equity market too, has happened in the rearview mirror. I think going back to the CPI print, though, and I think Mike is 100% right on this, look at the input costs, right? Because we've talked about energy, talked about services, but I don't think we've talked a ton about food inflation, for example. Chipotle was a great example today. They were actually able to pass on some of those costs to the consumer. But if you continue to see, say, higher avocado prices, higher meat prices, and that show up in the CPI numbers, well, that's going to impact of course, your food sectors, your restaurant sectors, and other companies that are far more dependent, I should say, on those price increases.
Higher avocado prices. Now we know things are getting serious. Mike, final quick question to you. Critty raises the issue of food. Let's talk about which areas of the basket are going to continue to increase. What's happening with rents, for instance?
Well, rents are going to be something that will be with us for a while, increases, because we've seen home prices go up so much through November, 17.5%. And because of the way they calculate it, it takes a long time for that to get into the CPI. They're going up at about 0.5% a month. So that should still continue to put pressure on the overall inflation number. Food is an interesting question because it's dependent on so many things that are beyond the control of anybody. The weather, not just here, but around the world. Suppose we have a problem with Ukraine and Russia. Russia's the world's biggest wheat exporter. So it's kind of hard to make predictions, but right now it looks like food inflation may be sort of topping out.
And of course, that's why we strip out food and energy, both of which are more volatile, and look at that core metric. But the fact of the matter is that is what, at the end of the day, people feel when they go to the grocery store or go to the gas station. Thank you so much to Bloomberg's Michael McKee, as well as Kriti Gupta. And coming up, she's betting on higher oil prices. Speaking of prices at the pump, she's also betting on higher rates, but still more consumer spending. We'll speak with Nadia Level of UBS on her sector picks next. This is Bloomberg.
Let's check in on the Bloomberg First Word News. I'm Ritika Gupta. Hong Kong reported a record of more than 1,100 new coronavirus cases today. Many were linked to family gatherings during the Lunar New Year. Emergency services are said to be overwhelmed. Meanwhile, here in New York, the state reportedly will drop its stringent indoor mask mandate. That's according to the New York Times. The mandate requires businesses to ask customers for proof of full vaccination or require mask wearing. A New York judge has granted bail for 2 people charged with trying to launder billions of dollars worth of Bitcoin. The cryptocurrency was stolen in a 2016 hack of the Bitfinex currency exchange. Ilya Lichtenstein and Heather Morgan were arrested yesterday. The government says it seized about $3.6 billion worth of cryptocurrency from the couple. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Kaylee.
All right, Ritika, thank you very much. Now let's get back to the markets and back to our question of the day. It has a little something to do with weather and temperature. Would hot or cold CPI brew a bigger storm for these markets? How much will that inflation data tomorrow make an impact? We're joined now by Nadia Level, UBS Global Wealth Management Senior U.S. Equity Strategist. Nadia, given how much has already been priced in, is there even room for there to be a surprise to the upside on inflation that makes a difference for this market?
I don't think so. You know, the market is already looking for something with a 7% handle, and that's priced in. So if we get something much hotter than that, you could see a bit of a choppiness and further pivot into the areas of market that will benefit from higher rates and high inflation. So that's financial and energy. We saw that happen with the better than expected job numbers on Friday. But if you get something much lower than 7%, that might say to the market that maybe inflation is starting to moderate and maybe the Fed doesn't need to be as hawkish. So you could see an uplift to areas like technology that has been under pressure, as we know, due to higher real yields. But I don't think that the market will lean too much into that narrative just yet. It's a bit early. The market, 1 month does not make a trend. The market will want to see a couple more months of moderating inflation to really get confirmation that maybe we have turned a corner.
What are you expecting, Nadia? What do you guys think is going to happen tomorrow? How are you positioning around one of the more important inflation prints that we're watching as we march our way towards that next Fed meeting?
Yeah, so we think that you do get something in the 7% handle range. And so from a positioning standpoint, we have continued to like value as a result of that. We've continued to like financials and energy. We do, however, think that inflation will peak in the first half of the year. So probably this February, March, we will see the peak and then start to moderate. And we head to the back half of the year. We're more looking for inflation to settle around 2% by the time we get to the end of the year.
And you obviously like the consumer discretionary sector here, and I'm wondering what bearing inflation has on this, because Guy and I were just talking about avocado prices, which are up something like 38% in a very short amount of time. It's a lot more expensive to get your guac at Chipotle. The consumer has to be able to tolerate that. They have to have the spending power to tolerate that. What gives you the confidence in discretionary and that they're going to be able to continue to do so?
You know, there's still, the consumer's balance sheet are still looking good, still flush with cash. And like I said, I do expect inflation to moderate. Companies continue to see their pricing power. But one of the reasons why we also like just consumer discretionary sector is, as we know, this is one of the sectors that's been most disrupted by the pandemic and the restriction. So we think spending will start to broaden out to the travel and leisure areas of the sector. And that should be a tailwind. You know, we have vaccine boosters, antiviral pills. All of that should help improve consumers' comfort level and the economy and the service side of the economy to over more broadly. And that should be a lift for the consumer discretionary sector.
Nadia, you guys have got the end of the year on the S&P with a 5 handle. 5,000, yes. 5,100. June to December, you're varying in terms of your targets. You think we get to December, 5,100. What gets us there?
Economic growth continues to remain above trend. We think that that will continue in the back half of the year. And when you look at the earnings season, you know, we've had some high profile misses, but we've had a lot of beats as well, right? In fact, the average beat rate has been about 6% or so. That's above the historical average. And so the earnings picture still looks good. We are expecting EPS growth of 12% this year. And I don't think that's too heroic, particularly as the service side of the economy reopens more broadly. And so we do think that valuation also come in enough. And with that earnings growth, really our price target is reflective of the earnings growth expectation that we look for this year.
On the subject of valuations, Nadia, how much higher can yields go before you start to get nervous about some areas of this equity market?
I think if you start to see the 10-year shoot through 2.5%, then you might start to see some jitters in the market. But our expectation is for the 10-year to get to 2.1% by the end of the year. We could see some bouts where the 10-year gets to 2.3% in the first half of the year. But I think as, you know, PMIs start to moderate in the back half of the year, but still remain in expansionary territory, we're likely to see yields, as they have historically, come down more to that 2.1%. But I don't think that that will be too problematic for valuations until we get into that 2.5 to 2.75 range.
Nadia, what would you avoid right now?
I think it's a bit early to pivot like defensively. And so that's an area that we would not look to add to at this moment. We would continue to favor the more value and cyclical areas of the market. Also, tech, I think you have to be very selective in tech. Yes, tech valuation has come in quite a bit as real yields move high, but we do expect real yields to move even higher than where they are now. And so that could also continue to be a headwind for tech valuation. But there are some parts of tech that we continue to like, particularly in the mid-cap space, and some of those tech companies that speak to more like artificial intelligence, big data, and cybersecurity, as there's continue to be demands in those areas.
Nadia, really great to see you. Thanks for joining us on the show. Really appreciate it, as ever. Nadia Lovell, UBS Global Wealth Management Senior U.S. Equity Strategist. Thank you very much indeed. Isabel Schnabel, from the ECB, from the Governing Council, from the Executive Board, is doing a Twitter Q&A right now. You can probably find it on Twitter, but let me bring you the headlines from it. She's talking about inflation. She's saying that the risk is that inflation continues to rise in the near term, might inflation to remain high for longer than anticipated. Remember, she is a hawk. She comes from the more cautious wing of the ECB. Let's put it that way, the more hawkish wing. ECB certainly accounting for uncertainty in decision making. Projections are always surrounded by uncertainty, but there remains a high degree of uncertainty around the inflation outlook. We have seen a bid coming back into particularly the periphery today. You're certainly seeing BTPs, after being badly beaten up over the last few days, at least today catching a bid. But again, tomorrow's CPI prints out of the States could be an important factor here as well. What are we going to talk about next? Omicron certainly putting a significant dent in Lyft's ridership in the fourth quarter. We'll find out later if Uber did any better. We've also got Disney coming up. We'll talk about all of this next. This is Bloomberg. Okay, so let's talk tech. Lyft reporting fewer riders overnight than analysts had been expecting in the fourth quarter. Omicron dampening travel demands. We've got Uber coming up. What's the read across one to the other? Joining us now to try and answer that question from San Francisco is Bloomberg's Ed Ludlow. Ed, walk us through the numbers from Lyft and what they mean for Uber.
Yeah, so ridership depressed, right? Depressed year on year, depressed versus kind of pre-pandemic levels. And it's because of Omicron. That was kind of the pain point in the fourth quarter, but also the company saying that the outlook for the first quarter was where they'd feel the brunt of it. But what's interesting is some green shoots, right? Lyft saying that the revenue per rider is really on the up. And part of that, of course, is the more expensive rides to the airport. So the reason I say green shoot is it looks like kind of business travel, premium segment travel is returning. The difference between the two, Lyft and Uber, is that Lyft's core business is rideshare, and that's it. Uber has the delivery business and other mobility platforms to leverage, while Lyft doesn't.
Yeah, so it's kind of both sides of the stay-at-home versus reopening trade when it comes to Uber. Another company that really exemplifies that is Disney, in that on the reopening side, you have theme parks and the actual movies. On the other side, you have Disney Plus. Is Disney likely to fall victim to the same kind of forces as we saw with Netflix a few weeks ago?
This is going to be a fascinating quarter. You know, we learned in the previous quarter that Disney is kind of a live or die by Disney Plus subscriber ads, right? I think consensus is net new subscribers of 8.2 million, take the total past 122 million. Either side of that, you know, we've, based on past precedent, we've seen big moves in the stock. But there's a lot of attention this quarter around the theme parks for one reason. Comcast owns Universal theme parks, and in the quarter just gone, they had their most profitable quarter ever. You know, there's a lot of activity in spite of Omicron coming back. Disney, of course, had 50th anniversary celebrations at some of its theme parks. So there is a feeling that that could be a real boost. The content pipeline has been okay. Look, you got one of my favorites on the screen right now. You know, this slate of Star Wars content. You know, and so. But what's interesting, Bloomberg Intelligence very quickly saying second half of this year, content is king. Disney has a great pipeline, so one to watch.
I wish Alix Steel was here to talk to you about Star Wars, because I got nothing. But thank you so much to Bloomberg's Ed Ludlow. Disney is up more than 2% right now ahead of those results. Now coming up, we'll stay on the West Coast, and that logjam of ships isn't as bad as it was a month ago. We'll talk with the executive director of the Port of Los Angeles, Gene Soroka. This is Bloomberg. We're an hour into the U.S. trading session. There is a lot of green on my screen. Bloomberg's Abigail Doolittle is tracking the moves. Abigail?
There certainly is a lot of green on the screen. And it's broad-based, too, Kelly. We have the S&P 500 up more than 1%. Its best day of February. Of course, the month is relatively short, but nonetheless, the best day in more than a week. You also have the NASDAQ 100 up more than 1%. Real strength coming from that China tech index, the Golden Dragon China index up 4%. So real rebound for some of those ADRs. And then small cap doing quite well as well, up 1.5%. And of course, small cap yesterday had outperformed. Now, one cause for this bullish tone right now, and who knows whether or not it will last given all the intraday volatility recently, but we do have yields in. This is the 10-year yield and down about 3 basis points. Nonetheless, it did start the year around 1.5%, now closer to 1.93%, not so far from 2%. The big question is whether or not it will get over that 2% and how quickly. Tomorrow, of course, that key CPI report and reading on inflation. If we go into the Bloomberg terminal, we are going to see that rates and CPI, not surprisingly, tracking each other really pretty closely here. And what we're looking at in white, the 10-year yield on a monthly basis, and in blue, that CPI, 7%. Tomorrow, the survey is calling for 7.3%. Some are questioning whether or not it comes in as a surprise. Below, I think the low estimate on the street is 7. The high estimate on the street, I believe, is 7.7%. But which surprise would cause a bigger move? Either way, you can very clearly see that the trend is higher, unlikely to be interrupted anytime soon. Despite rising inflation, there is one stock that's doing really quite well, despite the fact that prices are rising. And that, of course, is Chipotle. Chipotle flying on the day, up 7%. They put up a very strong quarter. They beat. The forecast is strong. And even though they are having to raise prices, consumers really absorbing that, and digital doing very strong. We also have Omnicom up strongly, up 13.2%. There's a 7% short interest, put up a great quarter, the communications company, and the forecast solid. And Enphase Energy, another earnings winner, guy, up more than 8%. The solar company saying that this quarter looks great, and they also are boosting manufacturing in Europe. So these are a few of the stocks that really helping all the green on the screen that Kelly was talking about.
There's lots of it out there. It's interesting to see, and we were talking about this earlier, avocado prices up 38% year to date. Chipotle clearly able to pass on some of that cost. Abigail, great work. Thank you very much indeed. Bloomberg's Abigail Doolittle on what is happening with the markets this Wednesday. Let's talk about what is happening to another aspect of this inflation story, the bottlenecks, the supply chains. The focus has been firmly in this area, really, since this time last year. Earlier on, we spoke to Maersk's CEO, Soren Skov. He thinks actually these disrupted supply chains may be starting to heal now, and we may be just a few months away from starting to return to normal.
We're coming out of a pandemic, and we don't have much experience with that, to be honest. So basically what we are saying, we expect quite a strong first half of 2022, and then we expect what we call a normalization early in the second half. That's what will give us a result which is very similar to the one that we had last year, which was record-breaking in every dimension.
Soren Skov, A.P. Møller-Mærsk's CEO, talking to Bloomberg a little bit earlier on. Let's carry on the conversation now. Gene Soroka, the Port of Los Angeles Executive Director, joining us now. Gene, great to see you. Thank you very much indeed for your time. Soren Skov thinks maybe we start to see things normalizing later on this year. Are you with him on that?
I agree with my friend Soren. We're seeing, Guy, a movement of cargo pretty heavily through Lunar New Year, landings here in Los Angeles towards the end of this month of February. North American retailers continue to tell me they'll use Q2 to replenish inventory and get that safety stock at a more comfortable level. Then we'll have a chance, if we hit these two marks properly, to pivot into an earlier than normal peak season, end of June, early July.
Are you going to be able to do so on the labor side?
Three segments of labor. We still need a lot of folks on the job in the warehousing sector as well as trucking. But what you're alluding to is the contract with our longshore dock workers that's set to expire on June 30th. Those dock workers have been out on the job an average of 6 days a week since the pandemic began. They kicked off their annual caucus to prioritize negotiating points that will be driven when they sit down at the table with the Pacific Maritime Association later in the second quarter. I'm optimistic. You've got professionals on both sides of the table negotiating. These dock workers need to get paid what they're worth. There are several other issues that need to be tackled. I think everyone understands what's at stake here economically.
One other aspect when it comes to labor, Gene, is obviously what the impact of Omicron in terms of labor outages. The longshoremen have been working incredibly hard. Everybody's been trying to work very hard to get some of these backlogs cleared. But Omicron obviously has caused people to be out. What are you seeing right now? How quickly is that story healing?
Like many around the world and right here at home, Guy, the longshore dock workers got hit hard by Omicron. Probably about 10% of the workforce here in Southern California tested positive. Thankfully, those positive test numbers are going down every day. The workforce is getting stronger, and we didn't miss a beat with the cargo flow. Those numbers that we look at, Guy, that we've talked about before on velocity of cargo are all improving, and it's because the men and women have been out there each and every day. So I'm optimistic the month of February starts to see folks come back into the workforce. But again, even with those out sick, we did not impact the productivity here.
On the subject of the pandemic, we've seen and continue to see some pretty intense protests in Canada over vaccine mandates when it comes to trucking. It's closing some key conduits between Canada and the U.S., specifically a bridge in Detroit. Could there be any ripple effects of that when it comes to trucking and logistics in the U.S. that reaches the Port of Los Angeles, Gene?
It's always a concern, and we're keeping an eye on it every day. The American Trucking Association has stated many times that we're about 80,000 drivers short nationwide. We need more drivers in the port drayage industry here. It's not a matter of not having enough drivers. We've got over 660,000 commercial licenses that have been issued in the state of California. About 18,000 of those folks are registered to do business here at the ports. We need to make these jobs better. They need to be professions. Yep. We need to attract, recruit, and retain folks in this industry and pay them what they're worth as well.
Well, Gene, on that note, there is certainly a push by some of the contractors, some of the trucking contractors, suggesting that they should be unionized. Do you think that will go some way, unionizing some of these contractors, making them employees? Do you think that will go some way towards maybe improving those conditions, allowing a better dialogue, and maybe improving some of those shortages that you're suffering?
I do, but it's always a choice of the worker to see how they want to go on the job every day. What we've seen across the United States and even here in Southern California is that those folks who work in union organizations are just about in full employment every day. It's those who are unrepresented that we continue to see struggles with, whether it be pay, filling jobs, or requirements on shifts. That conversation needs to go a lot deeper, and it has to happen now.
As we move forward into the year when, in theory, some of these things may be getting better, what is the biggest risk that you see?
Well, we've got to do three things right now. Number one, while focused on everything else that we've been chipping away at for the past year and a half, we've got to look at improving American exports, getting our farmers and manufacturers back in the international game. Secondly, we've got to get these vessel services back on time to their scheduled performance standards, bringing certainty to the international and domestic supply chains. And the way to do that on both sides is enhance this look at supply chain digitization. We got to fan out from here in Southern California, bring in more participants, and have a nationwide look at information sharing. If we don't take this spotlight that's been on us and use it to improve the supply chain, the risk is we go backwards again.
All right, Gene Soroka, Port of Los Angeles Executive Director, thank you so much for your time. And coming up, speaking of supply chain issues, shortages, we're going to talk about the global chip shortage as well as tariffs and the impact that blockade we just asked Gene about is having on the U.S.-Canada border. We'll have a wide-ranging exclusive interview with the U.S. Commerce Secretary Gina Raimondo next. This is Bloomberg.
This is Bloomberg Markets. I'm Ritika Gupta, and you're looking at a live shot of the Principal Room. Tune in to Bloomberg's monthly series, Chief Future Officer. The episode featuring Macy's CFO Adrian Mitchell is now on Bloomberg.com and YouTube. This is Bloomberg.
We welcome now our TV and radio listeners, our TV audience and our radio listeners. We'll bring you all together because we have the great privilege to be joined by Gina Raimondo, the U.S. Secretary of Commerce. We're also alongside Bloomberg's David Weston. David, over to you.
Thank you so much, Guy, and thank you, Madam Secretary, for joining us today. It is indeed, Gina Raimondo, it is a privilege. I want to start with something that happened yesterday. The House of Representatives passed its version of a statute that's been called various things. I think it's now Make It in America Act. But in some substance, it really would invest a fair amount of money, $50 billion, in designing and manufacturing semiconductors here in the United States. Now it goes to conference. Give us a sense of what the impediments are in Congress. Is one of the biggest ones the $45 billion in the House version, not the Senate, to invest in supply chain?
Good morning, David. It's always great to be with you, and thank you for having me. So I first want to say it is impossible to overstate how consequential this bill is. As you say, it's a $50 billion investment in long-term investment in American manufacturing of semiconductors, which is a uniquely critical component. It's headed to conference, as you say, and there's a huge amount of bipartisan support for the vast majority of the bill in both the House and the Senate. I have just this week spoken with chairs and ranking members of the committees in both the House and the Senate, and also to Speaker Pelosi and Leader Schumer, and everyone is focused on getting it done quickly, and getting it to the president's desk. So I'm sure there will be ups and downs and disagreements, but we are all optimistic that it's something that can happen reasonably quickly.
Well, that's really reassuring to a lot of people who are concerned about this, but specifically on the supply chain issue, which, as I understand, is one of the differences in the two bills. You have been responsible on supply chain here in the United States. How critical is that $45 billion in the House side to get done what we need to get done, separate and apart from the semiconductor investment?
Yes, thank you. It's extremely important. Now, and by the way, there is broad bipartisan support for that as well, and the president had a similar proposal in his Build Back Better proposal. Whether or not 45 is the right number and it needs to be that large is a legitimate, discussion. But what I can say is there is no department in the federal government currently whose mission it is to monitor our supply chain, which is really mind-boggling if you think about it. So the proposal is to create, for the first time ever, an initiative here at the Commerce Department to monitor supply chains, make sure we have resilient supply chains, predict bottlenecks before they happen, invest in domestic manufacturing, which is why this is now being called the Make It in America bill. It has to happen, David. So the precise details, we will work that out in conference. But I think we're all living every day with a disrupted supply chain. We can never let that happen again. And that's what this bill is designed to prevent.
Madam Secretary, good morning. It's Guy. Thank you for your time today. Even if this passed today, even if this became reality today and money started getting spent today, it would be years before the first chip rolls out of the first fab. What can be done now to deal with the supply chain shortages in the chip sector that industry is having to grapple with day after day?
Yes. Let me say this, Guy, and I know you know this, and every business leader will agree with this. Once this passes, the president signs it, that in and of itself is going to unlock private capital. I was in Ohio the other day with the CEO of Intel. He made an announcement of a $20 billion facility in Ohio. He said he did that because he's assuming the CHIPS Act will pass, and if it does, it will unlock another $80 billion. So I think we cannot underestimate, industry is watching this. Industry needs this. Why do we need this? Because we want them to put these facilities in America, right? They're going to put these facilities somewhere to meet the demand. They need to be in America. So getting this passed now is among the most important things that we can do. Beyond that, the other things we can do now are just to bring together suppliers and consumers to increase transparency, which we are doing, encouraging the information sharing so that we can be sure there's no hoarding, there's no stockpiling, there's no price gouging. All of that transparency, which is what we are leaning into, increases trust in the supply chain, which will get rid of some of the bottlenecks. Long term, though, there's no free lunch here. The reality is we need to produce more chips in America.
More chips in America. You spoke a moment ago as well about making sure that they were produced in America. Madam Secretary, yesterday the EU unveiled its version of the CHIPS Act. The numbers are roughly similar. Now, clearly other factors are going to come into play here. But are you now in a position where you're having to compete globally? Other regions, other countries are looking to do the same thing. Is this an arms race that you now find yourself with?
Well, the reality is we're already in that global competition. China is pouring hundreds of billions of dollars to subsidize its chip manufacturing. So this is about competing, America competing, strengthening American manufacturing. As it relates to the EU, they are among our strongest allies, and we are already in discussions. One of the things I lead along with Secretary Blinken is the US-EU Trade and Technology Council. And in that council, we talk a lot about how do we coordinate our investments so that it isn't a race to the bottom, so that we have complementary investments, so that together the US and the EU are stronger, quite frankly, less reliant on China.
Well, let's continue the conversation about China, Madam Secretary, because the Commerce Department in data yesterday made it very clear that they haven't held up their end of the bargain on the trade deal struck in the previous administration with the Trump administration. Only have purchased about 63% of the $200 billion worth of additional goods. Some of your colleagues in the administration has said the difficulty is there's no way to hold China to account on that. Is the administration going to let China off the hook?
No. President Biden has been very clear. This so-called phase one agreement, we inherited from President Trump. It's not necessarily, it's definitely not what we would have done. Having said that, China signed up for it, and we intend to hold them to account. And Ambassador Tai, the U.S. trade rep, is in the thick of those negotiations now. But the reality is, and you saw it in the report that the data Commerce put out yesterday, China's not playing by the rules. They're unfairly subsidizing their companies. America can win. American entrepreneurs and businesses can outcompete anyone if everybody plays by the same rules and we have a level playing field. And what you saw in that data yesterday is China's not doing that. So we absolutely are going to hold them to account to live up to the commitments that they made, that they signed up for.
Madam Secretary, I want to turn our eyes to the north a bit here, if we could, to Canada, because there is that issue with the Ambassador Bridge between Detroit and Windsor. You know it well. I'm from Michigan. I've been across that bridge a fair amount of time. It really is the major point at which trade is exchanged across that border. What efforts are we making to try to help Canada on that problem? Has President Biden, spoken with his counterpart, Mr. Trudeau, in Canada? Have you talked with your counterpart?
I have not yet. Secretary Buttigieg, Secretary of Transportation, I know, is deeply engaged in this, and as is Customs and Border Patrol. We need to resolve this issue. At the moment, we aren't. I have been in touch with the auto companies and such. We are told it is not yet interfering with supply chains. However, it will. It's only a matter of time. So we, the administration, are aggressively engaged trying to diffuse tensions and increase the traffic flow. The other issue, as you know very well, being a Michigander, is folks forget about cargo. Folks use that to get to and from work. And so we have to get traffic flowing again.
All right, Madam Secretary, thank you so much for your valuable time. U.S. Secretary of Commerce Gina Raimondo, as well as Bloomberg's David Weston. Thank you very much. This is Bloomberg. Guy, admittedly, I've been waiting for this all hour because we are now going to talk about NFL football. And I actually have a valid excuse for doing so today because the Bloomberg Big Take story, which you can find at NI Big Take on the terminal as well as online, focuses on the NFL and specifically its changing attitude toward gambling when it comes to professional football. The league originally was very skeptical about this. Now it has embraced it fully, Guy, to the point where some of these companies, the likes of DraftKings, others, are sponsoring lounges within stadiums. You have owners like Bob Kraft and others that are invested in some of these companies. It's fully embraced gambling, and I bet there's going to be a lot of people putting money down on the game on Sunday.
Absolutely. Isn't the irony, though, that it's being played in California and that is a state that is yet to legislate? So no gambling in California.
Yeah.
Which maybe will take the sort of the edge off a little bit, but other states can definitely do it. So if you were to bet on this weekend's game, and I'm sure you're thinking about this, which way would you go?
I'd go with the Bengals, which is a little against consensus, but I have a lot of confidence in Joe Burrow now that he's out of his rookie year, and I think they have that underdog mentality, which I always like. So we'll see, Guy, but it's not even just about betting on who wins or loses the game or even point spreads anymore. You can bet on if Joe Burrow is going to complete his first pass, if Von Miller will successfully sack him at any point in the game. I mean, you can bet on pretty much anything at this point.
Can I just point out that I think Kaylee Lines is up quite early on Monday morning.
Yes.
It could be a brutal Monday morning. I'm not sure what time the game finishes and what time you're up, but I imagine the spread between those two
Very narrow
is
window.
fairly small.
Yeah. It's worth it, though, Guy.
Okay. I have no doubt that you will end up at least watching the highlights on your way to work. Maybe you'll have gone to bed early, but at least watching the highlights. I actually suspect that Kaylee Lines is going to stay up. As you may have noticed, she's fairly engaged in this subject. Certainly knows a lot more about it than I do. European equities, I don't know much about those either. European stocks are tracking higher today. We're up by around 1.8%. I think the real story, though, is some stabilization in peripheral yields. We've got a bid in BTPs. We've also got a bid back in Brent crude as well, which is significant. Tracking a little higher, up another 1% right now. Close is coming up. This is Bloomberg.